In Friday's Market Outlook video, we talked about the scenario that we needed to see today and at the latest tomorrow to be able to make sure that we continue this little intermediate run that we've had for another couple weeks with a near-term move to the upside. Well, we went a long way to getting that today. Even with how we started and how things traded out overnight. Another reminder of how more important trading during the day is versus trading during the overnight session, which is very light volume. A lot more important to trade here during the day. So nice, good gap fill today. We're going to talk about that. We're going to talk about now, is this it? Is that what we were looking for? Did we get that? What do we need to see? What's our short-term outlook here going forward? How does that impact the long-term outlook and any expected kind of intermediate-term weakness? So we're going to break all that down from a technical outlook and using these different charts to kind of give you an idea of what I'm expecting. And then we'll take a look at our trade for the day. It's kind of a common trade. I did a few of them for my class portfolio earlier today and did another. So today is an example of the types of trades that we've been doing in our class. So let's go ahead and get started. Today is Monday, June the 15th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, it's interesting how that 23% level is held up here pretty nicely with that moving average, the rising 30-day moving average. So we got light pink shading. We talked about this on Friday. Kind of the second time. A lot of times these intermediate runs can get a couple of these. Now, here we didn't get the light pink shading because we barely came down with that oversold near-term line. But this was the conditions for one, so we were really darn close to getting one. So I can actually lump that in here as the same condition as this. Very similar to this intermediate run, and we showed previous examples on Friday of multiple drops where we got the light pink shading, sometimes with the yellow line, sometimes without the light pink shading. So you can kind of get an idea. Again, oversold near-term line, oversold momentum line, extremely oversold momentum line. It's ripe for those conditions. Of course, with today's bounce, both the momentum and near-term lines also bounce, but neither one of them up to the upper half of the chart. The intermediate posture is still bearish despite the bounce, so it's going to be a matter of how much up we go. And as I mentioned today in the Market Outlook live video that we do at 3:30 Eastern, where we put on the trade for today, as well as we also look at all the old trades that we've done in these videos. We can come down, as I mentioned before, you can go from 0 to 23% easily. Like there's no significant support or resistance areas in here. It's very noisy. You can come down here pretty easily. But the flip side of that is you can also go from 23 to 0 pretty easily too. So keep in mind, as fast as we come down, we can just go up just as fast, right? And you notice here we went down a couple of days to a 23% level, and within 3 days we're right back up there. Now a little bit of pause there, but then we're just right back up. And then over here we come down to 23% of this big retracement. In a matter of a week plus. In a matter of 3 days, right back up. So as easy as it is to come down, it's just as easy as to go up to 0% level, if not a little bit higher than that. Again, remember, this is not a pullback. It's dropped to the 23% level is not a pullback. A pullback is when you break below the 23% level. Like we said, we've done before on the Russell 2000. Now, today the Russell got back up above. So as quick as we dropped here, we jumped right back up, which is a very good sign. On the flip side, we never did dip to the 23% level on the Qs on the NASDAQ 100. So when it bounced back up, it is finally showing light pink shading, with all the other indexes, the Dow Jones Industrial Average also had dropped below, but it had bounced back above its 23% level last week. So we're kind of bouncing back up in the short term. Now, granted, does that mean we're going to get a multi-month intermediate run out of this? No. In fact, we'll probably get another near-term run or two, depending upon how long it is. Your typical near-term runs, 7 to 12 days. That might, as you get longer into an intermediate rally, they tend to not last very long. Here we got one more near-term rally after this drop, 23% drop, and that's all it was, right? And then eventually the intermediate run declined, or the intermediate run stopped, and we finally broke the 23% level and then some, and got to the 38%, and then that broke, and the support broke, and there we go to that point. So again, kind of the worst, I've said before, the worst case scenario I'm expecting here is that we drop, that this is an intermediate pullback, and we pulled at a 38% level, long enough to get the intermediate line below 50, not necessarily hugely low, but get it below 50. We chop around the 0 to 38% level again until we break out and keep going back on a new intermediate run, which would be a multi-month intermediate run after that. Best case scenario is we don't do that. We come down to the 23% as we're doing right now. We bounce off of it and then go up for another week or two. And that's my expectation. That was my expectation before. It's still my expectation now. That we'll probably just kind of grind up here. Keep in mind that June seasonally is pretty weak, especially after options expiration. It gets really weak after the week after options expiration. So we'll kind of keep an eye on that. That's this week. And then there's some weakness going into the July 4th holiday. Then it takes off to July expiration, and then we have July expiration to October earnings season where we just don't do anything in stocks. People go on vacation. That might be different this year because not a lot of people go on vacation. And we've canceled multiple vacations. We keep rescheduling vacations, then canceling them again. We're going to be out later this week and decided not to go because of all the, still the increasing cases and problems that are going on. So we keep rescheduling our own. So we know how that goes. And so we might not have your typical summer swoon this year as we don't have very many people probably leaving on vacation or on, to get away from things. So we kind of keep our eyes on that. It's a weak bearish posture, but not even weak enough to be a pullback. But like I said, on the Russell it was. And on the Russell we have bounced back up. And so, that might be it. This might be all we get. It might just be a one-day little dip below and we're back through. You can see this old 62% level that from this drop that we had bounced up, that was the retracement level there. We had broken through it here. We got up to the 78% level. Breaking above that like we have on the NASDAQ would be a change in trend. And you can see how it's gone to new highs since. But hasn't done that. That's where we hit our resistance. We pull back below the 62% level. So back into this retracement zone here of this drop. And as with this bounce, we're back through it. So we'll see, if we can get back above that 62% like we did here and get going again, back up and eventually through the 78. I actually think there's a good chance that we do in the short term make our way through there. Like we've done on the NASDAQ, do it on the like we did on the S&P. The S&P we had broken through over here above its 78% level, which was sitting right here at the time. You don't see it now because I deleted it, but this was where the S&P 78% level lined up with this little peak. Well, we broke through that with this little island reversal, and now we've come back down. So there's a good chance we can get back up through there, maybe even up above the 0 and test these old high points before this intermediate run is over. That's kind of what I'm expecting to see. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here, hit the red subscribe button that pops out. Also, there's a subscribe button below the video if you're watching us on YouTube. That notifies you when these videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. It tells us that you liked our video and that you want us to do another one tomorrow. So if you want to let us know, if you like our videos, you want to let us know, click that thumbs up. You can do that right now while you're watching. If you don't like our videos, of course, you don't have to click on anything. While you're down there too, comment. What questions or comments do you have about anything we discussed in today's video that you want to kind of keep this conversation going? You can post that in the comment section below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. Takes you to a page on our site where you can subscribe for free. Follow us on Twitter for more content in between these videos. My handle is @DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our website, and check out some of these things over here on our page too. This is that Market Outlook Live I told you about. This is where you can watch that. Just click up there to watch this video. All of our monthly subscribers get access to that. Monthly subscribers get access to all of our classes. Brandon's very popular dividend growth investing class is tomorrow, as well as my option strategies class. So you get access to all 8 of our trading rooms when you subscribe to our monthly plan. You get some details there. You can also get some details here. When you click on the word pricing, you can see a comparison of the two plans that we have. Our premium subscribers get access to all these things, as well as all of our premium content and tools that we have available. We also invite you to engage with us here on social media. Click this heart. It opens up a new window. Hit that like button. Also hit the thumbs up icon on this. That takes you to your Facebook page, and like today's Market Outlook Facebook post. Again, that benefits us because the more likes these posts have, the more Twitter and Facebook promotes our content to all of our followers that follow us on those platforms. It benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most, so especially Facebook. So the more you engage with us on these two things, the more you can be able to see all of our content. All right, let's take a look now at the long-term charts, coming back to the charts here. And you can see really good week, at least a close today that kept us from having a really bearish candle. We do have a lower shadow. Obviously, we have a lower close, and we also have a lower low for that matter, which is the first time that we've had a lower low in a long time on this. You can see even last week's we had the low point was much higher. We haven't had a lower low since this week of May the 11th. But it is a lower low. So that's a pretty bearish weekly candle, but we're only a day into this. So, the midpoint of next week's candles, as of right now, would be at 30.52. We're trading right now at 30.66. So the more we can continue to this little short-term upswing by the end of the week, the more likely, if this doesn't end up being a bullish candle, next week's will. So you can see the high. We actually had a little bit of a high point today up above this week's. We briefly got up above the Hakanashi Open today, despite how much we had dipped overnight. We were down over 3% overnight. So very good sign, and again shows how important trading during the day is versus trading during the overnight session, where volume and liquidity is extremely light. Let's take a look at the 3 green arrow chart. So we had some red arrows. We got the 2 red arrows. The first red arrow to come back is usually, first green arrow we usually get back is the moving average. We never actually lost that one because that's the last one. That's the last red arrow we get. It's the first one to leave. So we actually never got that one. Did we come close on IWM? Yeah, IWM we actually did get it. We got the 3 red arrows all at the same time, and look, you can see one day later we got the green arrow. The stochastics is usually the next green arrow to occur, and then the MACD gives you the last green arrow. So we'll kind of keep our eyes on that. It's also the MACD is usually the first red arrow that we usually get. So kind of watch to see. I mean, that's a pretty decent bullish engulfing pattern on IWM. So it's a good sign that we could get up. In fact, I mentioned in Friday's video that either today or tomorrow we need to see us get right back above the 17-day moving average, and we are right there. So if we can continue that run up to a higher level here, let's get rid of that. If we can continue this run and maybe even get up above the 8-day tomorrow, then we're set. We're set for a new little run, however long it will last, a week or two. If we can't, right, if we stay down below the 17 and maybe even get back below the 30, that's going to be a little bit of a red flag in terms of we might be on pace to get that pullback now instead of later. I think that's less likely. It's a possibility, so something to be aware of. I think it's more likely that we continue and we close back above the 8-day tomorrow or Wednesday, and here we go, right back up to the upside. So if you take a look now at some of these different oscillators here, you can see, we didn't dip below 50, we didn't dip below the negative 100, so we kind of need to get back above 0, back above 60 relatively quickly to confirm that this is just a little bit of a drop. The DMI, the positive index did drop below 25. The negative index is still above 25, so we're still not out of the woods here. And then you look at the trend strength indicators. We're above the blue we still have strong trends. We can get back above the green, and then here we go again. So you can kind of get an idea of what we need to see in some of these oscillators to suggest that, that this is just a noisy drop and nothing more, not even a pullback. It's just a noisy drop and nothing more than that. So we're going to keep our eyes on those, as well as the you can see the point of control, which also happened to be sitting at the 200-day moving average and the 23% level, has held for support too. So very good sign from that. And again, another reason why we're more likely to bounce off of here for another week or two versus break and actually come down to the 38, because you expect support to hold until it doesn't. All right, now let's take a look at the intraday chart today. And you'll notice, so again, we gapped up, we came down. So on Saturday in my Q&A session, we talked with our premium subscribers. It's kind of a free-for-all. They can ask anything and any topic they want me to cover. We talked about how, if we're going to be bullish, we would actually prefer to open up today down. We prefer to gap down and then fill in the gap to the upside throughout the day instead of gapping up. We didn't want to gap up. We don't want bullishness overnight. We want bearishness overnight so that we can fill that in during the regular trading session. That's what we ended up getting, and that's exactly what we want. So we ended up closing above Friday's close. Very good close. We didn't get a higher high. We got a lower low. So it's not, we're not out of the woods yet, but if we can break up above and get up above this 310 level tomorrow and start to fill in that island reversal that we've had, very good sign. I mean, if we've talked, that's got some signs of a runaway gap. So the more the quicker we can fill it in, the better, right? The longer we go without filling it in, the more likely it's a runaway, and which means that we just have an intermediate drop here, which doesn't, can just go down to the 38% level, but that's, it might not come right off of that. Like, it's a matter of like spending some time down there to where the intermediate line pulls back. And so again, if we can get back above tomorrow's high and start to fill in that gap, we don't have to fill it all in, but if we can at least start to fill in some of it, then it loses that runaway gap possibility, and we can continue this little 1 to 2 week run off of this little drop, get back to the 0% level, if not a little bit higher on the next little rally. Let's take a look at today's volume. The volumes have been relatively big. It's dropped back down today, but still above average, 135 million. The trading range was almost double. Well, not almost double, but more. Almost double, pretty close, getting relatively close to it. When you put that into perspective, an 11.5 point range is way up here. So that's still a pretty decently sized range to the upside. And then the 135 million shares is still higher. So remember, when these numbers go up, that's not bullish, right? That's bearish. So again, we had a big down day. We had a decent sized couple of days here. We don't want a lot of these big moves, right? We want smaller moves. So you can see on this daily change chart, this one right here. The VIX is still above historical volatility. It needs to get back below volatility to confirm the bounce is done. We need to, start getting smaller moves, not these 1 to 2% moves, and especially not these bigger gaps. We need to start getting small gaps and smaller moves, and so that will help, and that will help also with the VIX to get the VIX back into this neutral zone, if not back below 90%, and maybe stay this time. But you can see as of right now, we're still kind of at this level where we're not out of the woods. Like, we can't say, oh great, we've bounced now we're done with this drop. No, it could be a little, it's noisy between 0 and 23%. It can be very noisy. So don't get wrapped up in the big drops like we've had. Don't get wrapped up in the bounces either. Not until we break one or the other, the 0 or the 23, can we say either we're getting a pullback or we're still going, this little move we have is gone back now. We're moving the 0% line up, like the trend's still running. So we haven't had either one of those. So we're just still in a very noisy pattern. I just looked at the TV and I see on the TV a huge sell-off today. The market's rallied after a huge sell-off. It was not a huge sell-off. I mean, even at the lowest today, we were still holding the 23% line. So again, the only reason why these moves are as big as they are is because of how wide the 0 to 23% gap is. There's nothing more, and the reason why that gap is so wide is because we rallied 45% in 50 days. So, you have to keep that in mind. This was not a huge sell-off. Put it in context of the prior move. It's not a huge sell-off in the context of 45, especially it's not a huge sell-off in the context of a 30 some odd percent drop in 20 days that we just had. So big grain of salt. Don't get wrapped up in any move up or down between 0 and 23%. It's just the nature of markets, the nature of noisy moves. But there's a good chance that we have started a bounce up. We're not there yet. There's not everything looks great yet, but there's a good chance that we can continue this bounce today into the rest of the week. Very important day tomorrow, very important day Wednesday to kind of confirm this, because if we continue up and start getting smaller moves and start to grind, great. If we get a big move, either up or down with a big range and relatively bigger volume again, then we know there's still noise, right? We're still not out of the woods yet on this little drop that we've had. So we need to pay attention, because if we drop that 23% level, break below it, like we did on the Russell, then we could be in the mode of an intermediate pullback, bringing that green line down, which actually would be better for us in the long run, but not better for us in the short run, depending upon how bullish you are right now. So what do you think? Do you agree with that technical outlook? Do you disagree? There's a link popping out right there on the top right corner of your screen. Oh, excuse me. No, we don't do that anymore. Comment down below in the comment section and let me know there, especially if you disagree. What are you seeing? What are you watching that either makes you a lot more bullish, that we're going to get much more than a 1 to 2 week rally coming out of this little noisy drop that we've had, or you're a lot more bearish than I am, that this last week was just the tip of the iceberg, so to speak. So if something that you're seeing that suggests that, maybe you saw somebody post something or share a chart somewhere, share with us down below in the comment section what you're seeing there. All right, now let's come back to the charts and let's talk about what's driving the price action here today. So let's just go to today's move, and you can see the initial down and then the back up all in one chart here. You notice we started off with international stocks really struggling, down about 3%. The small caps were way down, but look at the run small caps went from being one of the worst performers, just barely losing to emerging markets, to being the top performer on the day. So Qs held up pretty well. I mean, they had a pretty decent game. They crossed above 0 first before any other asset class. Actually, small caps crossed barely ahead of, which says something, because there was quite the gap here. But small caps really rallied, and then on that late little news about the corporate bond buying from the Fed, small caps really ran up too. Corporate bonds are doing really well. In fact, they almost outpaced the S&P 500. In fact, they did briefly, just barely, by 0.02 of a percentage point outpaced. Real estate also did well today. Commodity prices ran up, but you can see how bonds started the day up, but finished with a small loss. Well, actually, it's very, very small gain. Global bonds flat. And you can see gold and the dollar both down, which is interesting. Again, kind of a reflection of the risk-on nature of the day today. The dollar, remember, has been kind of working its way down. Had a little bit of a bounce last week, but had been trending lower. And we talked about, this little bounce was nothing more than an oversold rally. Well, so far that's the case. We got up to the 17-day moving average. We're back below the 8-day. So that's very strongly bearish for the dollar. And TLT, which is measuring those bonds, it made a little bit bigger of a bounce up to the moving average. The 8-day is still below 17. As you can see, the MACD is still negative. But it's rising. So we'll see if TLT tomorrow can fill in the rest of this gap and break back below the 8-day and be more bearish again. Gold, remember, it's a little different story. As bullish as it is, if the dollar continues to drop, that is really bullish for gold, even if risk appetite as a whole. So you can see gold had been relatively negative, and now it's starting to show signs of bullishness to the upside today. With the gap down and then the rally intraday. kind of keep our eyes on gold, and crude oil had dropped down to its 17-day moving average and is bouncing back up above the 8-day and continuing potentially to rally. Here's the commodity basket as a whole. You can see a little bit of a bigger gap between the 8 and the 17, and potentially popping back up above the 8 and rising. Again, how important that is, because that's a reflection of increasing risk appetite. And I feel like there's an opportunity for this risk run to last at least another couple of weeks, another week or two, based off of this drop, this bounce to short-term support, and potential, to at least today, the signs of a bounce off of that. Let's take a look at the foreign markets. They've been showing some interesting. Let's take a look at the 12 grid here first. It's had, look at all the light pink shading. Now, of course, that's where your S&P is too, but light pink shading all across the board. But look how strong today's bounce was in a lot of these areas, and some of these areas even stronger, like Japan, Korea, China. They're closer to the moving averages. Canada's down there, but some of these are really strong. Germany's strong, Italy's strong, Brazil is bouncing up pretty strongly, France is pretty strong. So they're all showing these kind of these one-day bounces, big gaps to the downside, moving up off the lows. Now we need to fill in those gaps, right? We need to confirm today's bounce. If we don't, then another indication that we can start getting yellow lines, because some of these we would have had a yellow line had we closed there, but start getting yellow lines, if not eventually dark pink shadings and red lines. They're all in the 70s, so nothing's really too close. The only one that's the closest to getting dark pink shading is the UK. But if we don't confirm this bounce tomorrow in some of these charts and get back above that 8 and 17-day moving averages and stick there, then again, that means that there's tomorrow, Wednesday at the latest. That means that we just get an intermediate pullback, and that just means dark pink shading. And it doesn't mean that we'll retest these lows. It doesn't mean that we'll go lower. It doesn't mean the world's going to end. It just means that there'll be some weakness for a little bit longer term than just a day or two, which is crazy. I know that seems like that's a definition of a bear market lately, but that's we'll get some more weakness. That'll last a little bit longer, and like I said, eventually in the long term, that's actually more healthy for us, because that can start a multi-month intermediate run instead of hanging on to the current one that we're on for another couple of weeks before we eventually get that intermediate pullback. All right, now let's take a look at how the sectors performed today. And the sectors had a very similar, it was a very similar turnaround. So let's just go to this today alone, because again, when things are bearish, it's small caps, it's energy stocks, it's industrials and financials, and they struggle when things are bearish. And you can see by the end of the day, financials went from the second worst performer up to the second best. Communication services kind of held the lead all throughout the day. Those are your Google, Facebook, or any kind of media companies. Energy stocks went from a 4% loss to a gain on the day. So while they still finished with the worst performance, they still had a relatively large move. Healthcare continues to kind of lag. They were a big winner during a lot of the rally, but they continued. By the end of the day, utilities kind of lagged the whole day. They had a little bit of a bump up here, along with consumer staples. Everything else kind of pretty much matched. A bounce up in financials, a drop in healthcare, communication services leading the whole time, energy lagging the whole time, and those were the pretty much the outliers. Everything else up about 1%, kind of matching what the market was doing. Remember, going into this move, like if you look at the last 2 weeks now and how things had been performing, this was, energy, financials, industrials were the big winners, and they had pulled back during this drop. And then by the end of this, you can see staples, healthcare, and staples, healthcare, utilities, all lagging, even during the decline. So again, it kind of shows that this little drop is not a pullback, right? A pullback would, you'd have, your safe haven areas would lead. If I were to just go from 6.9, so this is the last week. So this is kind of where the drop started, right? Because 6.9 we started down and we were bearish. Since then, You can see financials, industrials, energy dropping, utilities down, staples, did okay, but look at technology and communication services still leading, and that's, this performance, relative performance. You can see that and here, let's just go to the daily chart. Well, this is the weekly chart. So this is the week. As of right now, we started down, but then finished the day up. So this was QQQ relative to IWM. If I were to change this, so just look at how things performed here today. So let me change these weekly moving averages to a daily moving average instead. Then you can see the how we perform. Like we started way down here, but then QQQ did really well, relatively speaking, by the end of the day. And that's your technology, your communication services, your consumer discretionary stocks kind of all fit in that category. And that you can see the MACD is turned up. The histogram's still rising. The PPO has been flattened, and the histogram of the PPO is rising. So we're still, we're not, we haven't changed this leadership. We're still very strongly bullish, and even the relative strength is still above 50. So we're not quite there yet. We're flirting with IWM, but remember, if we're going to have some pretty decent extended outperformance in small caps relative to the Qs, then that usually means both of them are coming down. And that would be more than just an intermediate pullback, more like a long-term market sentiment pullback that could potentially lead into more of a bear market mode. Because remember, Qs, before this whole thing started, before it went parabolic at the beginning of this year, before the coronavirus became a U.S. issue, the Qs have been outperforming. Most of 2019, the Qs have been outperforming. Pretty much since the low in October, that fall low point in risk aversion, where global risk aversion really kind of took off and safe havens took off, the Qs were outpacing IWM this whole time, and just went parabolic here during this run. And that parabolic move has settled down. Obviously, as you can see, it's settled down, and it hasn't flipped. Usually, when you get a big move in one direction, you kind of flip in the other direction. So keep that in mind. Same thing on the PPO. That takes a lot longer. But keep in mind, you usually get as big of a move in the other direction. When you do kind of flip, when you do break out, you get a move in one direction, the same size move in the other direction. So, that's why I say, eventually when these two things come down, it's not going to just be a little breather. It's usually going to mean a kind of more extended risk, kind of a real bear market, right? Not just a big fast dip, but a real bear market where we, have this long extended run, say below the 200-day moving average, and then death cross environment, and these end up being more negative. But I don't see that happening anytime soon. So I expect that this outperformance of the Qs will continue to grind up and get up to relatively lofty levels, if not back up to new highs, kind of flirting again with this 14 to 15% area again as the MACD works its way back to positive levels. All right, so for our trade idea of the day, I wanted to take a look at Salesforce. It's been on the nice bullish run. It had light pink shading and yellow line. We bounced off of it today. Very, very good move, a strong move up today, a couple percent. And it's been on the nice strong trend. You can see from a long-term perspective, we're in a golden cross environment, kind of flirting with that rising 50-day moving average. From a 3 green arrow perspective, we've had a little bit of a pullback, but now after opening below the 30-day moving average and closing below it a couple days ago, we're right back up above the 8-day, and the stochastics is above its moving average. The MACD is rising. Some of these oscillators are starting to look better. If you take a look at where the Bollinger Bands are, the stock came down to the top of its value area, held that for support so far at least, and is looking like it's potentially pushing up against the upper band. It's really getting close to the upper band again. We had a day like that. We got up above it a couple days ago, pushing back up against it again. We'll see how that plays out with a very low bandwidth. And also, too, that bandwidth is low enough to where the Bollinger Bands are inside of the Keltner channel. So that sets us up for a squeeze type play, too, if and when we break out of these bands one way or the other. And the expectation is, considering the trend, that we'd break out to the upside. But the question of it suggests that, rather than being too directionally bullish on this, we will instead look at doing a kind of a more higher probability type trade, since it has a high probability chart set up, a nice good bullish trend, but not the type of setup where we expect that it can have a big long directional move, because we don't know. So we say, okay, well, we do know we have pretty decent support below us, so we'll sell that 170 strike, buy the 165 strike. We did 3 contracts here because that sets me up for a normal position size for what we use here in our account, in our class account. And you can see it's already up since we put the trade on during the Market Outlook Live video. That's one of the benefits of coming to the Market Outlook Live. So you can see these trades before I put them on at the market close. And then we'll try for the $1,000 of risk, try to get a few $100 of reward and let that play out. And for those who are premium subscribers, I sent out a couple of trade alerts too for our directional option strategies class for a couple other short put vertical spreads that we did today, because that's the type of market we're in right now. And a pretty strong trend, high probability trend, the possibility of at least a few more weeks of bullishness. But while we kind of hang on to the rest of this intermediate run, so we'll take advantage of what we got and trade in that direction without necessarily being too directional. So if things do work against us, we're not hit too hard to the downside. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link to go to our website at marketscholars.com, to our Market Outlook forum, our message board, and be able to create any thread there with any questions or comments you have about anything we talked about in the video today, and reply to other people's threads too, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below, follow me on Twitter for more content between videos at DavidSettle42, and join our site to be able to go to those forums, as well as join our community, our Facebook group that we've created. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.